What's up, everybody? Welcome back to the channel. I'm Investicor, and today we're breaking down the top 5 market movers you need to watch this week. Every week brings new events that can shake up your portfolio, so staying informed is key. We'll cover central bank moves, inflation data, major earnings, and more, giving you the context to make smarter financial decisions. No hype, just the insights you need to navigate the markets. Smash that like button, and let's dive into the first big market mover. Central bank decisions, especially from the Federal Reserve, the ECB, and the Bank of Japan, set the tone for global markets. Their interest rate moves impact everything from your mortgage to stock prices. This week, markets are watching for policy updates and meeting minutes. The big question: when will the Fed start cutting rates? Persistent inflation keeps delaying those cuts. Investors will dissect every word for hints. Will policymakers stay hawkish and keep rates high, or turn dovish and prepare to cut? If rates stay high, borrowing costs rise and stocks may fall. Higher rates also make bonds more attractive, but any hint of a rate cut could spark a rally. Lower rates mean cheaper borrowing and more growth. The ECB faces similar challenges. If they cut before the Fed, it could shake up currency markets and global trade. A decision in Europe can ripple all the way to US companies. As an investor, you need to know which way the wind is blowing. So, keep your eyes on the Fed, the ECB, and the Bank of Japan. Their decisions will drive the action. Let's move to the next market mover. Next up, inflation data, specifically the Consumer Price Index, CPI, and Producer Price Index, PPI. These reports are the why behind central bank moves. CPI tracks the cost of living for consumers. PPI shows what businesses are paying for supplies. If PPI rises, those costs often get passed to consumers, pushing up CPI. Investors watch these numbers closely, comparing actual results to Wall Street expectations. A hotter-than-expected inflation report means the Fed may keep rates high, which usually hurts stocks and boosts bond yields. A cooler report is a green light for possible rate cuts, often sending stocks higher. But it's not just the headline number. Core inflation, which strips out volatile food and energy prices, is key. The Fed focuses on core inflation to spot underlying trends. If core inflation stays high, even with a good headline number, the market could still react negatively. Pay attention to the details. Is services inflation, like rent, cooling off, or are prices still sticky? Sometimes the market's first reaction to these reports is wrong. Wait for deeper analysis before making moves. Think of these reports as the economy's report card. Lower inflation means the Fed can ease up. Higher inflation means they'll stay strict. Your investment strategy should follow the trend in these grades. When CPI and PPI drop, it's a positive sign for markets. If they surprise to the upside, brace for volatility. Don't get caught up in the noise. Focus on the why behind the numbers. Look for which components are driving inflation. This will help you avoid emotional decisions and build real financial intelligence. Watch the market's reaction, but dig deeper. Understanding inflation data gives you an edge. It's a crucial piece of the puzzle this week. Let's see what's happening on the corporate front. On to the next mover. Now, let's zoom in on corporate earnings, where companies reveal their financial health. This week, major players are reporting, and their results can move the entire market. Investors focus on two things: revenue and earnings per share, EPS, compared to analyst expectations. Beat expectations, and the stock usually jumps. Miss, and it can drop fast. But future guidance is just as important. Strong forecasts can lift a stock even after a weak quarter, and vice versa. Watch for key sectors. If a retailer like Walmart reports strong sales, it signals healthy consumer spending. Weak results or cautious guidance can raise recession fears. Tech giants like Apple or Nvidia are especially influential. Their performance can sway the whole S&P 500. Listen to what management says about trends like AI, cloud computing, and advertising. Are they cutting costs or investing in growth? The tone tells you a lot about their confidence. Industrial companies' reports can signal broader economic trends. Slowing orders may hint at a downturn. Even if you don't own these stocks, their results affect index funds and entire sectors. Use their insights to gauge the health of the industry and economy. Check the earnings calendar for companies in your portfolio or watch list. Look past the initial price move. Focus on the story and future outlook. Did they beat or miss? What's the guidance? Connect the dots between company results and the bigger market picture. Earnings season is your chance to get ahead of the trends. Let's move to the next key indicator. Our fourth market mover, economic growth indicators, jobs, manufacturing, and GDP. The jobs report is huge. It shows how many jobs were created, unemployment, and wage growth. A strong report usually means people are working and spending, but too much strength can keep inflation high and delay rate cuts. The market wants a Goldilocks report, not too hot, not too cold. Watch wage growth. If it's too fast, it can fuel more inflation. PMI reports, Purchasing Managers Index, for manufacturing and services, give a real-time snapshot of business activity. A reading above 50 means expansion. Below 50 means contraction. Weak manufacturing PMIs can warn of an industrial slowdown. GDP measures the total value of goods and services produced. Positive growth means expansion. 2 negative quarters signal recession. Even revised GDP numbers can move markets if they surprise. No single report tells the whole story. Combine jobs, PMI, and GDP for a full picture. If the consumer is strong but manufacturing is weak, adjust your strategy accordingly. Think of these as the economy's vital signs. Use them to diagnose the market's health and guide your investments. If growth is slowing, consider defensive sectors like healthcare or consumer staples. If growth is resilient, growth stocks may outperform. Align your portfolio with the most likely scenario. These indicators are your best clues for what's next. Now let's talk about the wild card, geopolitics. Finally, the wild card, geopolitical developments. Wars, trade disputes, elections, and natural disasters can shake markets without warning. Ongoing conflicts in Ukraine and the Middle East are major sources of risk. Any escalation could spike energy prices, fueling inflation and slowing growth. A tough combo for central banks. US-China tensions are another big factor. New tariffs or tech restrictions can disrupt supply chains and hit company profits. Political surprises, like unexpected election results, can shift policy and create uncertainty. Markets hate uncertainty, and knee-jerk reactions are common. Don't panic. History shows markets often recover unless the event causes lasting economic change. Diversification is your best defense. Spread your investments across sectors, regions, and asset classes. Stay informed, but stick to credible sources. Don't get caught up in sensational headlines. Ask, does this event really impact earnings or supply chains? For example, if a conflict threatens a major shipping route, the impact could be huge. If not, the effect may be limited. This week, keep an eye on global headlines, but don't let fear drive your decisions. Geopolitical shocks are part of investing. Plan for them. Don't react emotionally. A well-diversified, long-term strategy is built to weather these storms. Stay focused on your goals, not the noise. Understand the risks, but don't let them derail your plan. The world stage is unpredictable, but preparation beats panic. That's how you invest through uncertainty. Let's wrap up with your action plan. Stay sharp, stay diversified, and keep learning. On to the final thoughts. That's your guide to the top 5 market movers this week. We covered central banks, inflation, earnings, growth indicators, and geopolitics. Everything you need to watch. Don't react to every headline. Focus on the big picture and long-term trends. By tracking these signals, you'll make smarter, more confident investment decisions. If you found this helpful, subscribe for more practical finance tips. Join our community of investors working toward financial freedom. Drop your thoughts or questions in the comments, I read everyone. Thanks for watching, and I'll see you in the next video.